Hello and welcome, everyone. I'm Masha Batra, Head of Partnerships at Kilimanjaro Consulting, and we are delighted to have you join us today. Today's session is focused on Payday Super. It's about what the recent changes mean, how they may impact your organization, and most importantly, the practical options available to help you navigate the transition successfully. To guide us through this important topic, we're pleased to be joined by James Haslam. James is widely recognized as a trusted authority in payroll and HR technology. Throughout his career, he's helped organizations modernize their systems, strengthen compliance, and optimize workforce processes. As a former CFO and COO of Elmo Software, James brings a unique blend of strategic, operational, and practical expertise to today's discussion. We're incredibly fortunate to have him with us. Towards the end of the session, we'll also spend some time exploring the options available to businesses as they adapt to Payday Super requirements. In particular, we'll look at how organizations can support employees' access to earned wages, especially if they are considering moving from a weekly or fortnightly payroll cycle to a monthly payroll cadence. To help bring this to life, we'll be joined by Steph from Cash, who will provide a demo of how Cash real-time remuneration solution can help businesses reimagine payroll. Essentially, Cash enables employees to access a portion of their earned wages before payday, helping maintain the financial flexibility while allowing organizations like yourself to adopt payroll practices that best suit your operational needs. A few things to mention before we dive in. Today's session is being recorded and will be sent to the attendees and people who have registered. You will see a Q&A button within your Zoom interface. Please feel free to ask us anything relevant to this topic throughout the session so others can also see the questions and add to the conversation. We will reserve time at the end of the session to answer these. Also, you'll see a few polls pop up on your screen. We'd love to hear your thoughts and experiences, so please take a moment to share your input when they appear. So without wasting more time, please join me in welcoming James and Steph. Over to you, Steph.
Thank you for having us, Masha, and good morning, everyone. Thank you all for joining today. The level of interest in this webinar really highlights just how important this topic has become for employers. So rather than spending any more time talking about why we're here today, let's just get straight into it. One of the reasons that we're excited to be partnering with Kilimanjaro is that they sit at the center of these conversations every day, helping organizations navigate payroll, compliance, and workforce challenges. As many of you would know, Kilimanjaro has built an outstanding reputation as one of Australia's leading MYOB enterprise deployment partners. They work closely with businesses every day to help them get the most out of their payroll, HR, and finance systems. That makes them ideally placed to help organizations navigate the changes ahead. What sets this partnership apart is that Kilimanjaro haven't just partnered with Cash, they've also implemented the platform within their own business. That means that they have first experience of real-time remuneration from both an employer and employee perspective, which we believe says a lot about the confidence that they have in the solution. For those of you who don't know Cash, we are a real-time remuneration platform. However, today is not about Cash. Today is about Payday Super and payroll and how payroll is changing. Today is about understanding what Payday Super means for employers and exploring the practical options available as organizations adapt to one of the biggest payroll changes we've seen in years. Now, when you think about it, almost everything around payroll has changed. Banking has changed. Payments have changed. The way we shop has changed. The way we transfer money has changed. Employees now live in a real-time financial world, but payroll still largely operates in a weekly, fortnightly, or monthly basis. That's the gap that exists today, and that's the conversation we're increasingly seeing organizations have. Today is really about three things: what's changing, what it means, and what organizations are doing about it. We'll cover the impact Payday Super can have on payroll operations, cash flow, and workforce planning, along with some practical strategies employers are exploring. Most importantly, We want everyone to leave today with a clearer understanding of what they should be thinking about next. That's exactly why we're so pleased to have James with us today. So rather than focusing on the headlines, James is going to explain what Payday Super means in practice, what organisations should be thinking about now, and the practical implications for payroll, cash flow, and workforce planning. James, over to you.
Great. Thank you, Steph. And thank you, Marsha and the Kilimanjaro team for letting me have the opportunity to speak with you today. So, yeah, morning, everybody. Look, this is a really timely topic. We're now 1 week into Payday Super being live. So if you run a weekly payroll, this means you've probably already lived through the first run. So if that's the case, then congratulations. So I'm really hoping that's gone really well for you. So by way of introduction, my name is James Haslam. I'm the founder and managing director of Financial Agility Consulting, where we provide CFO consulting services for companies that are in startup phase, scale-up phase, up to mid-sized organizations. Before Financial Agility, I was the CFO at Elmo Software. We had the benefit of planning for this transition in advance. And I'll come back to that a little later this morning because of some practical lessons that I learned from that experience that are really relevant to today's discussion. So as a quick recap, since Wednesday last week, so 1st July, every time you pay your employees, you then start the 7-day business clock for paying superannuation to their superannuation fund. The quarterly buffer that we all enjoyed is now gone. So it's now what we know as a payday obligation, which now falls weekly, fortnightly, monthly, depending on your payroll cycle. Importantly, it also intersects now with the final quarterly payment this month, which is now known as the super cycle. And we'll touch on that a bit as well, especially around working capital and implications. So what I want to run through with everyone today, take you through this, the sort of practicalities, just a brief recap on what it is, just in case you're still coming up the curve. What has actually changed then on the 1st July? Frequency is one element, but there's some other call-outs I think are super important to understand. A little run through the compliance requirements, just to understand like what you need to do, and also what happens if you get it wrong and like who is responsible. That brings us to whether there's a transition period. What is the process of kicking something off and implementing? And then finally, I'd like to wrap up talking about the working capital implications, cash flow implications for your business, because I think this is one topic that's probably not been talked about enough as everyone's focused on sort of the detailed compliance steps we have to run through. So I'll begin with a little bit of background, because understanding this reform sort of puts into context why there has been this change. The starting point was back in the 23 to 24 federal budget when Payday Super was announced. The core problem the government was trying to solve with Payday Super is unpaid super. So under the quarterly system, employers could literally hold super contributions up to 4 months before remitting them to the employee's fund. In that time, if a business became insolvent, those contributions often disappeared. Now, the Treasury Department acknowledged that this could cost billions of dollars of superannuation could go unpaid, which directly impacts the employee retirement balances. And this reform also reflects a broader trend towards real-time financial obligations, aligning super with their wages are actually paid, not with a quarterly accounting calendar. The objective is important, but for employers, the question I think is more immediate, like now, who is actually caught by these changes? Well, Payday Super applies to all Australian employees who have superannuation guarantee obligations. And this broadly covers all eligible employees. So that definition hasn't really changed. And also a number of independent contractors paid wholly principally for their labour. The rate hasn't changed. 12% is still the calculation. However, the basis is slightly altered to now we've used the term qualifying earnings instead of ordinary time earnings. So we'll just touch on the differences in a little bit. So now we know it's covered. The next step, I think, is just useful just to compare the system that we're moving from and what we're moving to see the basic changes. So what did the retired system look like? So under that system, superannuation guarantee rules were employers must pay the contributions at least once per quarter. The contributions must be received by the employee super fund within 28 days of the end of the quarter. So that cycle would be 20th of July, 20th of October, 20th of January, 20th of April. Employers could pay more frequently if they so wish, but it wasn't the legal minimum requirement. The superannuation guarantee was calculated from ordinary time earnings. If you defaulted, the superannuation guarantee charge, the penalty regime, would kicked in on that quarterly cycle. And finally, a super important point for particularly for small businesses, the ATO's Small Business Clearinghouse was available, and is the key thing here, available to companies with 19 or fewer employees or revenue turnover at less than $10 million. So what has changed since last week? Under the new system, the rules are quite different. Super is paid now in line with the pay cycle, not quarterly. The contributions must generally be received by the employee super fund within 7 days of the payday. The earnings base, so this qualifying earnings versus OTE, are similar, but qualifying earnings is broader and can capture commissions, salary sacrifice, contributions, and other relevant salary and wages amounts. The Small Business Clearinghouse, the SBSCH, a bit of a mouthful, that closed last week. That actually you couldn't join it from October last year, but formally now it will not take any payments through that system. So you must find an alternative. This changes the super stream as well. So these are to support faster processing times and improve data quality and better error handling. You may know when you process super, the clearinghouse can hold the payments for a few days before they reach the fund. And we'll come to that again in a little bit in their penalty regime. New starter process is really important too. Employers need clean onboarding. You need to be able to do the stapled lookup for their fund that comes with the employees who already have a fund, and the ability to use the member registration requests as well as member verification requests to validate exactly where their super fund. So when you put that together, this sort of move from the two platforms or the two regimes, the practical impact is pretty significant because most Australian businesses, in fact, over 80%, I understand from the ABS data, pay weekly or fortnightly. So that means that a company that is on a weekly payroll is paying currently has been paying 4 superannuation installments a year, is now lifting up to 52 events a year. And that's very important from a procedural standpoint, not before we get to the cash impacts of this. So thinking about that frequency now, taking this policy now into execution, I think it's really interesting and to step through what you actually need to be able to do to comply. And as I said, some companies, people on this call will have already gone through this over the last week. So the compliance checklist that I run through, firstly, is it sounds simple, but to check your payroll software, is Payday Super ready? It must be able to calculate the superannuation guarantee on every payroll using qualifying earnings. It must be able to submit the Pay Prevent Super data through your single touch payroll and interface with a clearinghouse or super payment solution that supports the Payday Super changes. If you haven't done that already, I suggest you do that as soon as you get off this presentation to make sure that it's working correctly. Secondly, if you're using the Small Business Super Clearinghouse or have been using it, you need to move off it to another compliant solution. Now, around 250,000 Australian businesses were accessing this free government service before. So it's not an insignificant task to move, and there will be capacity on other systems, but it is really important that if you were using that it will no longer take payments. A third step, clean up your employee super fund data. Under the old regime, there's a lot of time, the quarterly plus the 28 days to make the payments. Under the updated SuperStream settings, the error tolerance is expected now to tighten. And the errors are typically things like incorrect member names, account numbers, unique superannuation identifier numbers, tax file numbers, fund details. All these things happen if you process your payroll quarterly or process super quarterly, that you would, these things would have these errors that come back and you get some time to fix them. But now you haven't got as much time. So I think it's really important to audit these records now, use the member verification request to pre-validate existing fund details, and member registration requests were required for new employees that are onboarded. Next step, your single touch payroll reporting. Submissions must include the pay prevent super liability data. Check with the payroll provider this is active and reporting correctly. The ATO will use the STP and fund receipt data to match payment timing against payday. Now, the trigger here is this is how they're going to monitor compliance. They've got this real-time data. Next step I'd go through would be your payroll governance. So your payroll process is no longer complete when they're paid, when employees are paid. It's complete when the super has now been remitted and confirmed. So you need to build that super remittance into the pay run checklist. Your finance approval workflows must not add delays that push contributions outside the 7-day window. If your current clearinghouse, and touched on this before, takes 3 to 5 days to process the payment, that eats into the 7 days, not on top of it. Next step is handling the out-of-cycle payments, bonuses, commissions, some salary sacrifice arrangements. These things that might not happen on a regular pay run, make sure that these also get captured and treated correctly. Check your, touched on this before with the new starters, but yes, check your new starter onboarding process and your software that you use to onboard employees. Request their details early, make sure that's in the workflows. The stapled fund process we're required, and understand any timing rules that apply to new starters, and using that, as I said, that registration process, the verification process, and that should be part of your onboarding for any new person that joins. An eighth point is to test the salary sacrifice and additional contribution arrangements. So do not only test the superannuation guarantee calculations, test how salary sacrifice works, additional contributions, executive arrangement, total fixed packages. So anything that's slightly off the ordinary, just make sure that they are tested as well. Touching from the executive side, so high income earners and the maximum contribution settings. Now, there's going to be a nuance this July, and you may have come across this already, whereby we're paying a quarterly and a monthly or weekly or fortnightly payment could all happen at the same time. And that's going to have a problem with it's going to be a problem with the cap for people who already hit that level of earnings. So the configuration needs to be reviewed for those high income earners, annualized maximum contribution based treatment, etc., to make sure that you can plan around that. Next step is to tighten your upstream time and attendance and pay code data. And what I mean by this is around the frontline workers, the casual, the award heavy businesses. So Payday Super readiness will start before the payrolls run. Your time and attendance data, your roster approvals, your overtime classifications, allowance mapping, pay code all need to be correct before the SG can be calculated correctly. Next step, going through all these, it's really important that you keep an audit trail of what you've done and a contingency plan if things don't go well. So think about keeping the evidence of your pay run, the pay date, the calculations, the STB submission, the clearinghouse submission, any rejection notices you get back, what we've done about them, the corrective actions, fund receipt confirmation. It may sound obvious, but there's actually quite a lot to do in that one step of just being comfortable. We've pushed the payments out, but making sure that any follow-up we've worked through. Take allowance, things like public holidays, the Christmas shutdown, seasonal closures, and what happens when payroll staff leave. If you lose a payroll officer and you have a gap between the next one, who picks it up, because you haven't got that luxury of that time buffer any longer for the payment of the superannuation. I don't think there'll be any tolerance given for these sort of events. And the final step, which will lead into a bit of working capital discussion in a bit, is prepare your cash flow, because it does really fundamentally change how you operate your cash flow now from this quarterly cycle into weekly or fortnightly. It's going to have an impact. And it's going to have an impact in July with the super cycle. So we'll talk a little bit about that in working capital. So that's the sort of the regime and the compliance, I think, that you need to go through. So what happens if we don't get it right? Who's at risk? So I think when the change has become very real, this superannuation guarantee charge that does exist in the old system on the quarterly cycle, but now it applies if contributions are not received by the employee super fund within 7 business days of the payday. And I don't really, it's not clear if you can get any extensions. So I wouldn't rely on any type of what you might hear in extensions. I'll just try and follow that 7-day rule. So there's 3 components for the SGC, the super guarantee charge. The shortfall amount itself, which is the unpaid amount, interest that will apply daily and compound daily. And that's based on the qualified earnings calculation. And then there's going to be an administrative uplift set around 60% of the shortfall, which is designed to set the cost of enforcement and incentivize early disclosure. So it could be quite punitive in the sense of being late or getting things wrong. So it's a very critical point. Is late on with super will be much more expensive than if you pay correctly and on time. So once a shortfall exists, the broader penalty framework can also become much more severe as it grows. And I understand the maximum penalty can be up to around 200%. So please get on top of any of the compliance points and get processing as quickly as possible. And we touched on it before. So how could you get pinged? How could you get captured? So the ATO is a lot more sophisticated than ever in terms of monitoring compliance. And now they have the access to real-time data. The STP, which has been around for a while now, that reporting calculates the payroll events as they occur. And the Superfund data captures the receipt. The ATO is simply, we're looking at automatically matching these two to identify where there's a shortfall. So they will do it directly. They might know before you know. Its employers can no longer self-assess and lodge statements, which could happen on the quarterly regime. So the ATO will assess and they'll issue notices directly. Doesn't mean every mistake will be treated the same way. There's still be an incentive to act early and disclose these issues as they come up. There's one sort of issue that I do want to just raise, which I think is really important. It goes to the genesis of why they brought these changes in, and that's around the safe harbor requirements for directors. So this is where companies aren't doing so well. Under the Corps Act, directors can currently access safe harbor protection from insolvent trading, which is pretty significant from a personal liability perspective. But this only applies if you're meeting employee entitlement obligations, and this includes super. So any director, so if there's any company that may be struggling, that may be on this call or may know someone who's struggling, that the safe harbor requirements only apply if you've met these payday super requirements. And if you're relying on deferred superannuation as a cash flow mechanism, these safe harbor requirements will not be available to them. So the message on these penalties is simple: is no longer administrative cleanup. No longer can we use this as a working capital mechanism. Immediate compliance, there's real cost, there's real implications for people and directors. So it's very important that we take it very seriously. Then the next question would be, well, we've got this regime. This is sort of the penalties that go if we don't get it right. But is there any form of transition that we can rely on? And the way I characterize it is there's some administrative flexibility, but no legal grace period. So the ATO back in January published a practical compliance guidance note, and this set out how the ATO will allocate its compliance resources, because if every company and every employee is now subject to this, it's quite hard to administer even for the ATO. So through the first year, so this note was to govern the first year, so up to 30 June 2027. And right, it's not legal protection, it's more the approach they're planning to take. They bucketed 3 tiers. Their first tier is a low risk, medium risk, high risk. So what gets you into which bucket? Low risk has been characterized, I would say, employers paying their contributions on time, acting transparently, demonstrating strong internal controls, correcting errors promptly. Employees are less likely to face much scrutiny if you're in this zone, right? So you can, if there's mistakes are made, but you fix them quickly, you're likely to fall in this low risk zone. A medium is characterized as employers making efforts to comply but are experiencing recurring delays or inconsistencies. Right? They will form part of that medium risk, and we'll see a lower priority than compared to high risk. However, they might find themselves getting investigations and audits from the ATO if there's persistent issues. And then there's a high risk bucket. So the high risk are if you're blatantly ignoring the new process, you're repeatedly late with payments, the calculations are incorrect, there's limited engagement when the ATO asks questions. So these companies will be the primary focus. And I don't really think it's been put as a size of company. It's more the fact of how you approach the rules itself. So if you flagrantly ignoring them, likely to be in the high risk. And again, it's a framework, and it shouldn't be misunderstood to be reliant on from a legal sense, but it does give you an idea as to where resources are if you're having to go through some issues and you need some help to fix things as you go. So as I said, it's not a transitional rule. That's what we just can't rely on. Now, there is some commentary out in the market that there's not been enough time for many businesses to test the payroll. So I think there will be a little bit of practicality has to come into it, especially over these first few months. But I'd say if you're in the high risk zone, I certainly wouldn't want to rely on any delays or lack of resources from the ATO side. Now, there's one big transitional issue that I did touch on before, and this relates to this month, this July, around the concessional contribution cap. So this has been closely watched because there is actually, I would say, a technical breach that's been done by the government themselves in this case, because employers are paying their final quarterly instalment this month on the 28th of July. That is when your last super from the last system was. But you also begin paying superannuation now in July. So you end up with this double draw impact. So by the employees are now make both payments in July, and this potentially actually breaches the concessional contributions cap for an employee purely due to timing. So some it won't impact, but any of the higher income earners, it will impact. And so this isn't about increasing the employer contributions, it's more just the timing. So the government has indicated that legislative amendments are being considered to ensure employees are not adversely affected by inadvertent timing. But there's nothing in enshrined legislation. It's a watching brief with Treasury. So that's something to keep an eye on. So there shouldn't be any adverse impacts on the company for anything to do in that July period from an overall breach by paying too much super effectively into someone's account. So now I'd like to move a bit on to working capital that we've worked through the compliance and the risks and the penalties, etc. As I mentioned before, we have a fundamental shift. Super could be treated as a deferred liability before, and now it can't. This is where super moves from being compliance to cash flow. Under the quarterly system, the superannuation contributions effectively operate as deferred working capital. So business paying weekly payroll with a weekly payroll could accrue up to 13 weeks of super obligations before remitting them. That working capital float was widely used, even if unofficially, and I'm sure many people on this call may have done that too, and this supported day-to-day cash management. The float's now gone, and I'll run through a sort of practical scenario of what that actually can look like. I don't think this impact will be felt evenly across the economy. I think some sectors of business models are more exposed than others. So who do I think? High frequency payers, particularly if on a weekly pay cycle, construction, hospitality, transportation, labour hire, I think are sectors that just come straight to mind where I think there could be risk where they pay high frequency, but the work done and the invoicing, the receipts of the payments that done for your work may come 30 to 60 days after it's performed. So you've got a bit of a disconnect. You're paying up front for people and for people and the super, and you're collecting cash later, right? And that was your original in your original sort of modeling. Businesses with seasonal or regular revenue, where the quarterly float helps smooth cash flow peaks and troughs, could be impacted, and small enterprises who've relied on the super float and didn't have a formal cash management structure, but sort of just had that in their planning over the course of the year. And I do think this working capital is one of the areas where people got caught up in the compliance side, making sure the systems are set up and not put enough attention to actually the practical running of the business and the operating cash flow. And even if you are able to, you've got more stable income cash flows. Again, July I think is your pressure point where if you've got any thinness in cash, that's where you're going to have that the biggest impact. So in July, where the final quarterly payment goes out at the end of the month, and the first payday super contribution could have happened in the last week. So I think that double draw is got to be is very important that you've modelled that already, or have not. I would certainly get onto that today. And I just want to give you a simple example of how it could look. So take a business, 50 employee business, 100,000 average salary, equates to a super obligation around $600,000, so off of 12% on a 5 million payroll. So under the old system, you'd be paying $150,000 4 times a year, every quarter. But that will now shift to $11,500 every week, paying in that weekly cycle. So what that means for July is you could be faced with a $200,000 payment for superannuation when you would originally been expected to pay $150,000. That extra cash isn't always readily available. So that's why it's critical to start thinking around, how you match your cash flows and receipts and your payments, particularly if you've got long receivables time, 45, 60-day terms. You might not get the cash for the work done until August, September time. So that's a bit of the problem that sort of come your way. But now what can you do? So I'm trying to go through now some practical steps that you can do to actually help with that working capital cycle. So it sounds simple, a model, your cash flow, right? Run a weekly cash flow. I call it the 13-weeker. So you look at 13 weeks and do it on a weekly basis, making sure you're picking all your receipts and payments, identify specific dates that super, etc. is due to be paid, and compare them to the receipts, and then have a look at where the gaps are. So it takes a bit of work. It sounds. I make it sound very simple, but I don't know how much work is actually involved in trying to predict when customers are going to pay. And the more known is when you need to pay, as opposed to when the customers choose to pay. Consider opening a dedicated bank account for superannuation. Again, it's just pushing the money into that account and then not touching it for anything other than superannuation, so that you get used to that cadence of those payments. It might be you need short-term cash flow help. It might be you need to arrange finance, and that's talking to your bank or brokers, overdraft, invoice financing. You might need to do that in the short term if there is a cash drain on the company that could put it into any form of difficulty. Aligning debtor terms, bringing invoicing, shortening the terms. Now I know that's easier said than done, because customers get used to paying on the 30-day and then maybe they stretch it out. But even bringing the 45-day debtor term down to 30 days or down to 21 days can have a significant difference on the cash flows of the company. So it's trying to negotiate with customers to pay earlier is more beneficial. And then the last point on this is and Steph touched on this in Open Up too, and as Marsha, why don't you reconsider your payroll cycle? So appreciate sometimes there's difficulties in this with awards and EBAs, etc., but that doesn't affect every single company. But it's one of the bigger, most impactful structural levers that you can pull is on the payroll frequency itself. So if you just think about this for a moment, your current cycle may inadvertently be creating you this cash flow pressure and administrative burden, and it probably hasn't really been considered until now. And it's ironically, it's more in your control than persuading customers to pull forward paying their invoices. It's an easier thing to sort of do from your standpoint. And I can actually talk to this because I went through this. I did this in my previous role, where I moved us from a fortnightly payroll to a monthly payroll. So it's worth asking yourself the question: do you need to have a cycle as aggressive as weekly, or is monthly payroll an option? So that simple change can materially reduce the number of compliance events you have. 52 versus 26 versus 12 pay runs a year. It gives you more time to fix errors, helps regulate the cash flows. And as I said, I oversaw this shift, making this move. And why did I do it? Well, I saw from quite a way out that I could see the compliance issues that we would face, and fixing problems there was always an exception. There was always an error that had to be fixed. And so putting that time pressure of 7 days versus what was basically 28 days that you had before, putting that 7-day pressure, and then it compounds because you got the same problem the week after, etc. I thought we wouldn't want to go through that on a fortnightly cycle, so reduce that compliance pressure. So what was the main challenge? And I could imagine that people are thinking, if you're thinking this through now, your main challenge is not necessarily the complexity, it's probably more the people. So what I found, it took time. I took, no kidding, it took us 6 months to do the change. But that wasn't to do with technical, technical complexities working through moving the payroll. It was actually the employee engagement was the challenging part, because it's a very difficult conversation to have with hundreds of people who have now structured their lives around the timing of their income. So the employee communication is critical. So we went on a 6-month program of consultation, helping people with thinking about budgeting, giving them access to all these tools, etc., to help with that. And when we timed it, but it's super important that they understand what will change, what will not change, and why we would do why we're doing the changes. So when I was going through that, and when I reflect on that journey that we went through, and we successfully managed to do that payroll change. What would have been a lot easier was if I actually had a product like what Cash offer, enable the drawdown in real time. Because, as I said, the biggest pushback I got from it was, we're moving the payroll and I've structured my life around it. I didn't have access to that cash at 2 weeks mark, and now I only got it on a monthly basis. And that's where, the Cash guys, this is where they came in. If I'd accessed that product at that time, I reckon it would have taken weeks to certainly not months to do, because technically it's something that is a lot more straightforward than you think. So just want to do a quick wrap up, so leave enough time for any questions as well. So Payday Super obviously is not just a change in payment timing. One of the most significant operational challenges that I've seen Australian business go through in the superannuation era. Just a reminder, you've got 7-day clock that runs after making your payroll to get that money into the super money into the employer's superannuation account. Data quality is super important. Data and process can poor data and poor processes can slow down the timing of payments and can put you at that risk of breaching that 7 days. The ATO, way more sophisticated than they ever have been, and they will be doing real-time matching. So they will know if there are errors early, and they will trigger notices. Working capital hit is very real, and especially this month, and it will be ongoing throughout the year if you don't get on top of your cash flows, understand your cash flows, and building strategies to manage. So my final message will be: action now is significantly cheaper than remediation later. So model cash flow, sort out the processes, work with your payroll provider, and keep the evidence just in case things don't go wrong. Don't go right and things go wrong. Keep that evidence. So yes, if you haven't done so already and you do feel exposed, please seek advice, and you've got the great team at the Kilimanjaro, etc., to help and the cash to you guys as well. So Steph, thank you very much, and look forward to fielding any questions.
Thanks, James. Really appreciate that. One thing that really stood out from what you just shared is that Payday Super isn't simply changing when super gets paid, it's prompting organisations to rethink payroll a bit more broadly. And that's exactly the conversations we're having with employers. We're hearing, are we running the right payroll cycle? Is our current process still fit for purpose? How do we manage cash flow? And then how do we support employees through the transition? One of the challenges Payday Super creates is that organisations begin questioning whether traditional payroll cycles still make sense. Weekly payroll can reduce timing issues, but often increase costs in administration. Maintaining fortnightly or monthly payroll preserves efficiency, but then it can leave employees wanting greater flexibility. Now, historically, that's created a difficult choice. Increasingly, employers are realizing now they don't actually have to choose. They can retain the payroll cycle that works for the business whilst giving employees access to the wages they've already earned when they need them. And this isn't limited just to one part of your workforce. Whether an employee is full-time, part-time, casual, or a contractor, our platform calculates accrued wages in real time, allowing employers to provide the same flexibility across their workforce. There's no loans, no debt, no credit checks. And employers don't need to change payroll systems, create any additional administration, or alter existing payroll processes. So the payroll cycle remains a business decision, and employee access becomes an employee decision. One of the interesting things we see is that employees don't necessarily want to be paid more frequently. What they're really after is control. Now, life doesn't organise itself around your payroll calendar. A car repair doesn't wait till payday. Medical or dental expenses don't wait till payday. Historically, the options weren't great. You could just wait till payday, but I don't know, you can try that with toothache. I don't know if you'll manage it, but you could also try and use a credit card. You could borrow money through an overdraft or a payday loan. Now, one approach that we are increasingly seeing organizations explore is real-time remuneration, simply accessing the money you've already earned. That's why we describe it as the ethical alternative to credit. Real-time remuneration isn't just about helping employees when something goes wrong, it's actually also about helping them make better financial decisions when things are going well. For some, that might mean getting money into a mortgage offset account sooner. For others, it might be about building savings, planning ahead, or simply just having greater control over their cash flow. It's about giving employees another option, and the difference between providing access to earned wages and encouraging people to borrow. For many employers, this conversation extends well beyond employee flexibility. It's about maintaining the payroll process that works for the business while improving the employee experience. So along the way, organizations can strengthen financial well-being, reduce financial stress so employees can focus on their best work, improve attraction and retention, and support employees without increasing payroll complexity. You'll notice that we've used the term real-time remuneration throughout this today rather than earned wage access. Now, that's deliberate. Earned wage access describes a product, but real-time remuneration describes where payroll is heading. For decades, we've accepted that people work every day and can only gain access to their earnings when payroll says they can. Today, the technology exists to do things differently. We're witnessing the next evolution of payroll. That's why we believe real-time remuneration is a conversation more organizations will be having over the coming years. And as organizations continue adapting to Payday Super, there are 3 questions worth asking. Is our payroll process ready? Is our payroll frequency still appropriate? And how can we provide employees with greater flexibility without increasing payroll complexity? One way to think about this is payroll is the settlement layer. Real-time remuneration is the access layer. These two work together. Employers retain control, employees gain flexibility. So if Payday Super is changing payroll, real-time remuneration is changing access to pay. Now, before we finish today, we'd like to spend just 5 minutes showing you what real-time remuneration actually looks like in practice. So I'm going to give you a demo. So throughout today's session, James has explained why Payday Super is changing the payroll landscape. And we've spoken about how real-time remuneration can help organizations retain the payroll processes that work for the business while giving employees greater flexibility. Now, before we jump into the platform, there's one important point that I'd like to make. By the time you're ready to introduce cash to your employees, the hard work has already been done. The integration with the MyOb suite of solutions, including Acumatica, is complete. From there, enabling your workforce is remarkably straightforward. It's simply a matter of agreeing terms and then sending out invitations to your employees. From that point, employees complete their own registration and are ready to start using the platform. Now, as you're watching this demo, you'll probably think of a few questions. Rather than trying to cover every technical, commercial, and implementation detail in a 5-minute walkthrough, we'd rather showcase 2 things really well today. First is just to show you how simple the employee experience is, and second is to show you how easy it is for employers to introduce real-time remuneration. That's the purpose. We'll absolutely take general questions at the end of today's session, but for now, let's simply show you how easy it is to move from the challenge of Payday Super to a practical real-time remuneration challenge. So let's take a look. Now, as you can see, this is the cash landing page. And up top, you've got the login button. Now, we've designed this button to be a progressive web app that can be embedded anywhere. It can be white labeled or it can be cash branded. Visualize this being deployed within your own employee self-service environment. The first thing an employee receives is an invitation to join Cash. That is to their dedicated work email address, which is linked to their payroll. Registration is entirely self-service. Employees complete a couple of simple steps to verify their identity and create their account. The whole process only takes a minute. What that will do, it will bring you to the login page, and then we will put in our email address. And that's going to send a one-time password. Back to the page, put in the one-time passwords, and there it is. Now, importantly, there's very little involvement required from payroll or HR. Once the registration is complete, they're ready to go. Now, one thing you'll notice during this demo is first how simple it is for employees, and two, how little changes for employers. And finally, real-time remuneration fits alongside your existing payroll rather than replacing it. Now, once the employees log in, this is going to be the first screen they'll see. It's intentionally simple. There's no financial jargon, no complicated menus. Immediately, you can see on the left there the available balance. And then on the right, you can see how much they've withdrawn this cycle. And then down the bottom, you can see recent transactions. Everything automatically updates in real time as they continue working. There's nothing for employees to calculate, and there's nothing for payroll to manually update. Now, this is probably the most important part of the whole demonstration. The balance that you're seeing up here isn't a loan. It's not an advance. It's simply a percentage of the wages the employee has already earned through payroll. Employers determine the percentage of accrued wages that can be accessed, allowing them to balance employee flexibility with responsible payroll practices. This helps ensure employees have sufficient funds available on payday for regular commitments like rent, mortgage, repayments, and other essential expenses. Employees are simply choosing when they'd like to access those earnings. That's an important distinction because it changes the conversation from borrowing money to accessing money that's already theirs. So now we're going to make a transfer. So we just go to the withdraw money button here. Now let's imagine one of your employees has an unexpected expense. Let's go back to toothache. So instead of waiting till payday or relying on a credit card, they simply access the money, withdraw the money they'd like to access. So let's just put in $50 and you go down to the withdraw money and you can see on here the amount $50. You can see all the bank details are blanked out, so we can't see it. And then you've got the transfer fee at the bottom and you just click withdraw and that's it. I've got a notification on my phone that the money's there. It's as easy as that. The whole experience takes less than a minute, and from an employee perspective, it's designed to be as simple as any modern banking app. Okay, James and I have covered a lot of ground today, and I'm sure it's raised a few questions, whether they're about Payday Super, payroll implications, or real-time remuneration, and we'd be delighted to answer as many as we can. If there's any organisation-specific questions then that require a deeper discussion, we'll be happy to follow those up after today's session. Masha, back to you.
Thanks, Steph. And thanks, James. Lots of nuggets of gold in there. We do have a few questions. Just in the interest of time, we'll quickly go through this. The first question is from Chris. Could you please cover how we deal with an employee who chooses a default superannuation fund and does not have a membership number? Will we need to obtain a membership number in order to process a Payday superannuation file to our clearinghouse, or will this create an error?
That's a good question. On the processing side, I would have thought you would need a member number, but I think that's something you should check with the clearinghouse ASAP. I don't know in that specific example what would happen in that case, but I'll definitely follow that up. But we can help with that. Follow it up after.
Cool. Thanks for that. The next question is, just wanted to clarify that we process payment of super at the same time as we process payment on the payroll. that is net pay. Does the same apply to pay adjustments processed after bulk pay run?
So you have to process super it has to be in the employer's fund within 7 days. So it doesn't have to go out at the same time. So the pay hits the employee's bank account, but the super has to go in within 7 days. So what was that second part, Marsha?
The second part was, does the same apply to pay adjustments processed after bulk pay run?
So for the outer cycle, so they should have been picked up in term they would be the next payroll. They would have to go through the next payroll with any pay adjustments. They wouldn't have to go through if you're weekly payroll, you wouldn't have to process them midweek. They follow the next pay cycle.
Perfect. The next question is moving to monthly pay inevitable for white collar businesses?
In my view, yes. So I think it is. I think simply to manage cash flows, it makes an awful lot of sense, and that's why I think it's products like what Cash offer are quite key to helping that transition.
How can we best prepare for the pushback that comes with the changing pay cycles?
So the main pushback, so talking from lived experience, so the main pushback that I got was people set their mortgages up on a certain day. And if you pay fortnightly, they might pay the mortgage fortnightly, or they pay the way they pay their credit card, or they set the utility bills. They tend to be centered around when they're getting paid. So if you move back, that's the pushback. Is like, well, I've set my life up to do it. You're creating an administrative burden, and that's why I said about this product that Cash do. You take away that problem of having to wait a month for your pay because you can draw down your pay at any time in effect, which doesn't come out of the company. So it's an important point. It doesn't come out of the company's bank account at that point, right? That is funded, like by Cash will fund that, and so the working capital cycle for the company stays the same. So they process their payroll normally. The only time is the employee would receive a balance of their pay at the pay cycle, and the drawn balance will go refill back into fund the cashed account. So your employer only still makes that pay cycle payment. So when it comes to the employees, I think it's a bit of transparency as well. It's compliance. We don't want to have mistakes, etc. But if you have a more regulated pay cycle, a monthly cycle, I think it actually benefits the company and the employee ultimately, because it frees up a lot of capacity and time internally as well.
Understood. The next question is from John, and I think it's for you, Steph. It's relating to Cash. Is this available on mobile as well?
Yes, absolutely. It's available on Android and iOS, so you can download the page that you saw. We've got a very similar type page that will download on your mobile phone. So yeah, absolutely. So it's either can be done as a web app or it can be done as a mobile app.
Perfect. Next question is ad hoc pays where reversals occur. How will this be recognized for Super if, say, STP and Super has already been processed?
So corrections after the event, so reverse or effectively refund. So the corrections will happen the next pay cycle. I think that's the general rule of thumb. Is if there's a reversal, it would then be if they've been paid too much, and then I think it will get corrected in the next cycle.
Our last questions from Mary. How can we see the amounts of QE being reported to the ATO? We can't see them in manage STP submissions. What I would say is please reach out to your account managers. I'm aware Chimerica definitely has been geared up to deal with the Payday Super changes, so our teams would be able to guide you in regards to this. A lot of topics we covered in the discussion. I think a lot of you might be having Acumatica payroll. If there are any questions relating to that, reach out to your account managers. Any questions around what James has discussed on Payday Super, feel free to come back to us as well. Steph, do we want to just go through the last slide before we finish up?
So yeah, before we close, I'd just like to thank everybody again for their time today. And I just want to leave you with three takeaways from today's session. Real-time remuneration doesn't replace payroll, it works alongside it. The payroll cycle remains a business decision. Employees simply gain greater flexibility over the money they've earned, and introducing real-time remuneration is much simpler than most organisations expect. So if today's session is showing you that real-time remuneration could help your organisation navigate Payday Super, we're ready when you are. As I said, the integration is complete, so it's just simply a matter of agreeing terms and inviting your employees to register. And as a thank you for attending today's webinar, employee transaction fees will be waived for the first 3 months. So to get started, just simply contact the Kilimanjaro team at sales@kilimanjaro-consulting.com. Thank you again for joining us.
Thanks, Steph. Thanks, James. As Steph said, if there are any questions, if you want us to arrange introductions, demos, you've got the email address in front of you. Please feel free to reach out to us. We look forward to continuing these conversations with you. Thank you, James and Steph, for your time today, and have a good rest of your day, everyone.
Thank you, everyone. Thank you very much.
Thank you.